For more on all of this and what the banking sector looks like at large, we want to bring in Mike Mayo. He is managing director and senior banking analyst at Wells Fargo. We'll get to the drinks and why you're so thirsty in a minute, but let's talk about what happened with this deal. You've now got First Citizens up by 46%, so it looks like a good deal. You have other people complaining, though, that the FDIC is getting the raw end of that deal, that they are still stuck with $90 billion of assets and loans, securities that nobody wanted, and they're going to take a $20 billion loss, very likely, on all of this. I mean, there weren't a lot of bidders to step up on this. It took 2 weeks to get rid of it. What does it tell you?
Well, I think you have to look at the big picture. Remember, I was a negative on the banks for over 15 years, leading up through the global financial crisis. This is not the global financial crisis 2.0. Yeah. 2 weeks ago, the Fed and government reacted very quickly with the backstop to prevent these liquidity issues. A week ago, you resolved the Credit Suisse situation. Now you've gotten a major clearing event. So you've had the second and third largest bank failures in history, and now they're resolved. And the reserves, the FDIC reserves, were $128 billion at the end of the year. This is a $20 billion hit. That's not great, but in the scheme of things, I estimate this will cost banks about 3% of their earnings over 3 years in higher FDIC assessments. Not a big price to pay relative to the market cap destruction. And a point that's really gotten lost is all deposits are not created equal. So the average deposit size at Silicon Valley Bank, a venture capital deposit of over $1 million, is a lot different than a $10,000 retail deposit that's in a checking account at your typical bank. So you're extrapolating examples here with venture capital-oriented bank Signature in Silicon Valley to the entire industry, and that's wrong. And the catalyst for the issues at Silicon Valley is they were forced to sell those unrealized securities losses, right? They were forced to. You're no longer forced to do that, and hence my water, because the Fed is providing as much liquidity as possible. So there's lots of liquidity for any bank that does not want to sell their securities. You have tons of liquidity. So the idea of a forced mark-to-market liquidation value of banks is innumerate. So all these studies that show the unrealized securities losses, yes, it's visible and you have the value, but that's nothing like $50 billion of CDOs on Citigroup's balance sheet during the global financial crisis. You didn't really know what the number was. You didn't know what they were worth. When I asked the CEO of Merrill Lynch, do you have any of these CDOs left? And he said no, and then it turned out they did. You have good transparency, you have good valuation, you know what it's worth, and the innumerate part of this is you're giving credit for the unrealized losses without giving credit for the unrealized gains. So reality, banks are not forced to sell these securities because of all the liquidity out there. The Fed is providing that.
You're talking about the hold to maturity, the treasuries, and very good loans that they're talking about. There have been questions that people have been raising this morning, everybody from Chris Whalen to Josh Rosner to what Steve Leisman just brought up with others. What happens when you start looking down the line at their portfolios, when you get to some of the commercial real estate loans, when you get to some of the mortgage-backed securities? I mean, the Fed is not going to offer liquidity at par for all of those other loans, are they?
Well, let's break the problem down into its components. We have the bank crisis discount on bank stocks, but I'd really call that the bank crisis of confidence, spurred on by one event. All right, so I think we get over the speed bump because the government is doing whatever it takes to get over the speed bump, including having a $20 billion hole, which is paid for by the banking industry.